The objectives of my literally 10 minutes of speaking is going to be to remind everybody what Deloitte does in corporate finance. I want everybody to understand that we are in the corporate finance business and go through a couple of areas that we focus on. It's going to come as no surprise to people in the mining business that is an incredibly challenging time to raise capital. And the conclusion of all of this will be a bright spot called non-traditional sources of equity finance, and that's where Justin's roles and slides are going to be very interesting. We'll round that out with Kerry, Brad, and John talking about some of the more technical aspects of stream and stream financing. So just myself, I'm relatively new to Deloitte, come from an investment banking background, or looking at building a mid-market investment bank inside of the world's largest professional services firm, that being Deloitte. We come at the corporate finance business with the traditional lines of business, be it M&A, be it capital raising, be it on the corporate advisory side, and an area that we're really starting to focus on is the fairness opinion business. And what makes our platform a little bit unique is we are almost entirely focused on the mining industry from a corporate finance perspective. And what differentiates us from many of the firms that you may be talking to and the firms that I used to work with is we have a global business. We raise capital on a global scale. We talk about M&A on a global scale. So again, if any of you or your organizations are interested in understanding what your options are in either raising capital or buying and selling assets, we can help you here in Canada and around the world. And you get a sense of our team here in Canada. We run this business out of Vancouver, but it is a global business with a global mandate, and you can get a sense of the people that we've literally put in places around the world to help people like you understand the finance and M&A business as it relates to mining. One of the areas that we spend a lot of time in working with our clients is essentially becoming an extension of their corporate development team. So if you've got a small group looking at M&A or a small group looking at finance, we will come on and work beside you in understanding all of the options as they relate to defining a strategy for your business, working with you to narrow that strategy down to an actionable plan, going out and executing that plan, and all of this related to raising money or growing your business through M&A, wherever it happens to be around the world. Suggestion of some of the clients that we're working with. These are the global clients that we've worked with on the other side, where they've looked at Canada or the the Canadian mining business, and they're looking at understanding the industry, understanding the dynamics, and they hire us to help them identify opportunities. Some of the areas that you might not be aware of, just as if you look at those three pillars of the corporate finance business, on the capital raising side, we do raise money. You can see a couple of the transactions we've been involved in. You can see on the M&A side, we are working actively to sell a gold mine in Quebec and a base metals business in Europe. And then on the advisory side, if you look and can read that small font, we're advising the Koreans on Baja Mining and Vallejo, which has been incredibly interesting. And we just wrote a public fairness opinion for Waterloo Resources. So again, we're very, very active in the corporate finance business. Okay, so to get started, the first point we're going to talk on is, we can't really talk about capital raising or M&A if we don't understand what's happening in the market. And I'm sure all of you follow the market very, very closely. But again, the market at the end of the day is going to determine the value of the decisions that you make or the advice that we give. And it's fair to say when you look at the Toronto Stock Exchange, certainly over the last couple of 3 years, it's all about volatility. And if you read those captions closely enough, that volatility is really driven around three factors. What's happening in Europe, the pace of economic growth in the US, and what news is coming out of Asia and China specifically. I think the market's looking for clarity around all of these factors. But it's fair to say that looking at the volatility we've seen, that it's all about risk and the appropriate way to measure that risk. And if you look at the mining business particularly, we have two charts here. On the left side, this is over the last couple of 3 years, the blue line being the metals and mining index, and the brown line, the darker line, being the broader Toronto Indices. And of course, over the last couple of 3 years, it's been relatively interesting. But if you look over the last year, it's been incredibly challenging to raise money in the mining business. It's been incredibly hard to make money in the mining industry. And if you look at some of the statistics, even over the last 2 or 3 months that we've moved into this year, the U.S. market has significantly outperformed what we're doing in Canada. In fact, if you invested in a basket of U.S. stocks from the beginning of the year to today, you're up almost 11%, where you're just touching 3% in Canada. So it gives you a sense of the exposure Canada has to the mining market and the impacts that certainly it has when the mining business goes sideways. And one of the factors that is interesting is this disconnect between equity valuations and commodity prices. This is a chart that really shows that, what, from an index perspective, what is the percentage that index trades as per the price of gold. And it's basically showing that, commodity prices, although they've retreated, the equity valuations of companies that operate in that space has retreated much more significantly. So this is really interesting because in our view, this is why the market has gone sideways for the last year and a half, is the generalists who got into the sector that drove the valuations are now exiting. And this is why there's a lot of discussion today is, have we hit bottom when it comes to equity valuations in the mining industry? And this happens to just be gold. But there's a lot of talk about where we are in the cycle, where the valuations are, and we're seeing a lot more activity around the so-called sophisticated investors looking at specifically gold and saying, we think we're getting close to the bottom from an equity valuation perspective, and this is a time that private equity seems to be very active. We are certainly involved with private equity as they look at the industry, as well as offshore capital, be it the sovereign wealth funds in Asia or the Middle East, that are starting to redeploy a significant amount of capital. And this is the bright spot when you start thinking about raising money, and we'll get to this in a moment. It's the non-traditional sources of capital where there's been interest and activity, not necessarily Bay Street or Wall Street, but what we're seeing from private equity and the non-traditional sources of financing. A couple of issues I just want to touch on, which continue to be top of mind. One is CapEx. When we go out and talk to investors as it relates to raising capital for our clients, not only are they interested in the assets and the commodity and the grades, but they're also interested in the projects and how much are those projects going to cost, how long is it going to take, how many more months is it going to take to complete. And this is a real focus for investors today, is how big is the project, what is the financing risk, and what is the chances that it can go through over budget. And if you just look at some of these statistics, the average project today, and this happens to be copper projects, but is roughly 35% through budget. And you can imagine the return implications of missing your capital cost estimates by 35%. So again, a real area of focus for the market. The other area that gets a lot of talk right now is the jurisdictional risk that's been built into some of these mining stories. Certainly an issue for large diversified mining companies that have many assets located around the world, but there's a lot of focus today on what jurisdiction you're operating in, what is the tax regime, what could the tax regime become. And it wasn't long ago when Canada was clearly the place to be a miner, but obviously with things that are happening in places like Quebec, those views are starting to come under scrutiny. Australia the same way. I spent a lot of time in South America, and there is clearly becoming a bifurcation of countries you want to be in and countries that aren't so attractive. And people continue to talk about Brazil and Chile, and obviously Argentina is a big area of discussion, as is Venezuela, as things continue to change. But jurisdiction is an issue. And one example that is really interesting, of course, is Argentina. We talked to a lot of people about Argentina, and people are starting to rethink that that's actually a place that maybe buy back into because the valuations have retreated to such a degree. All this weaves into what we all know, which is an extremely challenging financing market today. These are just the statistics that you're all aware of, that raising money through traditional sources has become very, very challenging. Financings continue to move only in one direction on the Toronto Stock Exchange, and that's down. Areas that we look at for openings or windows is both financing junior and exploration companies and the IPO market. You can see the chart on the right-hand side of the page that there really is not an IPO market today for mining companies. We have to see that change before we see generalists in the broader market come back into the financing industry. But it's certainly an area that we focus on. And the other area that we look at, as I said, is our perspectives on funding and raising capital for earlier stage projects. Again, to see the mining market come back, those are the first signals that we would have seen as far as raising capital more broadly. Is there early stage capital coming in, and is there an opening of an IPO window? And here again, you can just see the performance of the developers and the producers of gold versus copper. Again, significant underperformance, which only goes to compound the problem of trying to raise capital. Now, the good news is traditional capital is on strike today, but there are very much some bright spots on the horizon, and we, as well as our friends at Stikeman's and Sandstorm, are very much involved in both the M&A business. This is the right time to be looking at M&A, the right time to be looking at your portfolio of assets. Strategic capital is another bright spot. Our team spends over half of its time in Asia, being China, Japan, Korea, and India, helping understand how do we bring that capital into the Western mining business. We have a very good sense of the types of projects they're looking at, the commodities they want to see, right down to the grades in the jurisdiction. So that's the strategic capital, which is very much a bright spot. And then the alternative financing is what Justin's going to talk a lot about, which is looking at streaming and other type of structured finance. I won't spend much time on these remaining 3 slides, but you can see the M&A, as I mentioned, is a very viable option. If you're not looking at your options and looking at your assets and looking at either upgrading or swapping assets to build your business, this is the time to be doing it. Valuations are low, and there are a number of very good assets that are going to trade at very attractive valuations. I talked a little bit about the strategic capital, and this, again, what I mean by that is there are almost 400 entities in China that have a mandate to own Western mining companies, and we are positioning ourselves as a firm right in the middle of that flow. So again, if you're not clear on what the Chinese or the Indians or the Koreans have to say about your business, then you're missing a big part of the financing market. This is an industry that is going to be, for the near term anyway, financed out of that region or that part of the world. And they are very interested in not only buying at the project level, but also buying equity in these organizations. And we can certainly help you as far as understanding what they're looking for and how they may be able to play a role in your business. And the valuations of these transactions are very, very interesting. This is a transaction we did for Fortune Minerals. We were able to secure over $180 million of funding for Fortune through a Korean steel company. And again, taking them on the road, having them meet our clients, our investor base, which is different than the investment banks. That's the key. And we were able to come back with $180 million in funding that business. So, and the valuations are very attractive. Although the capital markets will set the tone for how they look at your business, when you step back, they are interested in owning the commodity. They're interested in owning the coal, the gold, the copper. And for that, they place a different value than the financial market or the financial investors. So again, once you get involved in these types of transactions and talking to these kinds of buyers, it's a different dynamic, and it's very much a bright spot. So in closing, obviously the macroeconomic themes are driving what's happening in the mining industry today. The capital markets are tight. Traditional sources of funding are challenging. There are bright spots, which is you need to look at the non-traditional sources of capital, which continues to be very active. Justin and his team are as busy as they've ever been. You need to look at M&A as a viable way to the business, and it all starts with looking at your strategic options. Where is my business going? How are we going to get there? How do we use M&A? How do we use traditional and non-traditional sources of financing to get there? Firms like ours and Stikeman's can help you through that process, but that's the bright spot, is non-traditional sources of financing. And so with that as a bit of an opener and a bit of context, I'll turn it over to Justin Cochrane, who's Executive Vice President of Corporate Development for Sandstorm Gold and Sandstorm Metals Energy. Justin is responsible for sourcing, structuring, negotiating, and closing streaming transactions. So he's the right person to be talking to us about these transactions. And Justin?
Welcome, everyone. Thanks for coming. Thanks for the introduction there, Graham. He is right. We find ourselves in a bit of a unique position now as a streaming company, and ourselves and Silver Wheaton and Royal Gold and Franco and others alike, where we have quite a bit of capital to deploy, and these are the types of markets where we're seeing lots of opportunities. At Sandstorm, we have in and around $250 million to deploy over the next 12 months. Some of our competitors are sitting on $1 billion in cash and credit as well. So, good time to be in the streaming business, but it's challenging markets for everyone out there, and even for a streaming company, we need to make sure that we're picking the right projects to invest in at the same time. So what is a stream? If you break it down to, and sort of a funny graph that our graphics department put up here, but it involves an immediate upfront payment, which is money going into the hands of a mining company to build and construct and eventually operate a mining project. So you see the mine on the far right there. It also consists of ongoing payments that are designed to cover the cash costs of the mining company producing that commodity which they're selling to us. So in this case, we're giving money to a mining company, and in return, we're getting oil, gas, gold, copper, whatever it may be. So if I give you a quick example, it might be us providing a mining company with $50 million in exchange for 10% of their gold production. In addition to the $50 million, we would pay them, call it $500 an ounce, to cover their cash costs of producing those ounces of gold, and that would be a contract that would be there for the life of that project. So this might be a little hard to read. This will give you a sense of our track record at Sandstorm. We've been involved in more of these transactions than anybody else in the industry, from groups like Glencore and Goldcorp when the management team was previously at Silver Wheaton, to some of the recent deals we've done with like Colossus and Mutiny. If you look in the middle of the graph, the transaction sizes have ranged anywhere from $8 million to 1.9 billion, which was a deal that Silver Wheaton did with Vale not too long ago. So, it really is applicable for just about any size of mining company. It's more about the stage of the project, and I'll talk about that in a second. In addition to that, the ongoing payments, as I mentioned, they've ranged from $3.90 an ounce, which is what Silver Wheaton's done mostly on the silver side. On the gold side, anywhere from $0 is an ongoing payment up to $500 an ounce is an ongoing payment. And $100 or $200 an ounce if you're dealing with platinum and palladium. So it really can range, and it's a very flexible business model in that we can sort of pick and choose the size of the upfront payment, the percentage of the net asset value, the percentage of production that's coming from the mine, as well as the ongoing payments, and it all just works itself into a discounted cash flow analysis, which helps us value the stream on day one. So the other very relevant column here is the percentage of mine NAV, and you'll see it averaged around 20%, and that is by design. I mean, we need to make sure when we do streams on mining projects that we're not taking too much of the economics of the project. At the end of the day, we want everybody's interests to be 100% aligned. So we're very careful in structuring these things such that everybody's interests are aligned, and that our interests are the same as the mining company in expanding production and in exploring the property. So you can't afford to take too much of the production from these projects. So how does it compare over equity? The big benefit of the commodity stream is it avoids equity dilution, in that we're financing these projects at the net asset value of the project. So rather than a mining company going and raising equity at a discount to their already depressed share prices, and diluting every shareholder's interest in that project, the commodity stream is done at the project level, and it's done at the net asset value of the project. So there is no real dilution of shareholders' interests. And the fact that it is completed at the project level means that any other projects that you may have today or may discover in the future or may acquire in the future are not diluted by the fact that you're just raising equity for this single project. And of course, when you do a stream, you retain the ability to issue equity and debt, because at the end of the day, the stream is never going to provide 100% of the capital to build these projects. So you need to retain that flexibility to go to the markets and raise capital elsewhere. And so what at the end of the day, what streaming is really taking advantage of is this valuation differential between ourselves and the mining companies that we're dealing with. So in a streaming company, investors give us a premium valuation because of the diversified nature of the projects that we invest in, and the fact that we don't take a lot of the risks that a traditional mining company would take. So we trade at this premium valuation versus the valuation that the mining companies that we're dealing with are trading at. And in there, you've got an arbitrage opportunity. And as long as you're able to do a deal within that band, within that arbitrage, you can do an accretive transaction for Sandstorm and have it accretive for our shareholders on a relative basis, and have it accretive for the mining companies on a relative basis versus issuing equity. And it's really that arbitrage that we're taking advantage of. And that is something that persists whether you're in very healthy markets, where our NAV might go up at the same time that the mining companies' NAVs would increase, and in depressed markets like we are in today, where frankly our PNAV multiple has come down, but it hasn't come down as much as the mining companies' NAV has come down. So that arbitrage opportunity is always there. And so how do mining companies' share prices react when they do a stream? This is Sandstorm's experience over the last couple of years. Generally, it's been quite positive. We're showing up about 15% in the 60 days that follow announcement of a transaction. And the reason for that is when Sandstorm goes and does a deal with a mining company, we spend a lot of time marketing the benefits of that project or the great aspects of that project, because we're out there trying to raise capital just as much as the mining company might be trying to raise capital and from our perspective, we're raising capital to do new deals. But we have to be out there talking about the great aspects of the projects that we've invested in. So you get this, as from the mining company's perspective, you get this third-party validation from Sandstorm who frankly, we spend a lot of time on due diligence and dig into a lot of details that the typical investor is not able to do in evaluating these assets. And so we send a team out there, so you get that third-party validation, and you also, and that's a benefit that accrues for many years as we continue to market the Sandstorm story and raise capital and do additional deals. So, you know, we do spend a fair amount of time on the road marketing the company and marketing the projects that we've invested in. And so how does stream financing compare to debt, which is the other major form of capital? And the big difference here is that as a stream does not have the same risk attached to it that debt would have. And the biggest reason for that is there are no covenants, no hedging requirements, and at the end of the day, there's unlikely to be any real guaranteed payments that'll put the project at risk of shutting down. And so that's the big difference. And this is from a streaming perspective, we can complete these transactions in a matter of weeks. But the biggest thing that companies focus on when they come to us is the fact that we will subordinate to senior lenders in most cases where we think there's a prudent level of debt put on the project. We are happy to subordinate to senior lenders, and that's what retains the flexibility to issue debt at a later time. And so why is it less risky to debt? We had one of our summer analysts a couple of years ago, and she continues to update this, look at all of the single asset mining companies from 2004 until the middle of last year. How do they perform in the year prior to production relative to the TSX Venture Index? And we did this analysis on the level of debt that they would be holding on the bottom as a percentage of their market cap. So on the left you have guys that were debt free, and on the right you have people who've taken more than 20% of their market cap in debt. What was quite astonishing, and this was a relationship that we expected, but you know, the companies that in the 1 year prior to production that are holding too much debt drastically underperform the index. And it might be surprising, it may not, but people say, why is that? And the answer is because building mines is difficult. On the left graph, we're showing the percentage of projects that actually start on time, and as you can see, I actually thought the number would be bigger than this, but 78% of the projects do not start when they say they're going to start, because building mines is difficult. You see delays and capex increases, and it's challenging. Now on the far right side, we said, well, once they are into production, how much do they produce as a percentage of what they said they were going to produce in their first year? And what you'll see is, 66% or 2/3 of the companies produced less than half of what they said they would produce in the first year of production. So then imagine yourself being in a situation where you've levered up the balance sheet, you've got covenants and debt repayments and other obligations to debt holders, and now your mine is delayed and you're not hitting your targeted production. Difficult to perform well in that environment. So again, that's sort of why you see the performance from the page prior. And my computer stopped working. There we go. So versus other financing alternatives. So there's the commodity, other alternative forms of financing. There's the commodity stream, there's the joint venture model, and of course there's the royalty model. And a lot of people are under the impression that the commodity stream and royalties are the same, and they're not. So just looking at it on a high level basis, one of the big differences between a royalty and a commodity stream is the tax treatment. And Brad will get into this a little bit later, but for a royalty and a joint venture, they would be considered a capital transaction, which in most jurisdictions would trigger a capital event or a taxable event on day one, where the commodity stream, because it's a contract, is not treated as a capital transaction, and therefore taxes are deferred over as production is received. Same extent as on the burdensome side. A commodity stream is designed, as I said earlier, to pay those ongoing payments that are covering the cash costs of production. So therefore, it's not a burden on the project. That would be very similar to a joint venture partner. But unlike a royalty, where a royalty is generally taking just a share of the revenue off the top line, so it's not covering the cash costs of production, and therefore the stream has some major advantages that way. As I said, this sort of relates to the first topic. The stream, because it's a commodity, would not be a titled interest in the project, unlike a joint venture and a royalty. And then from an operational standpoint, the commodity streams are designed to be a passive financial investment in a project. And so there are no joint venture agreements, there are no operational agreements. We rely on our ability to pick good management teams to operate these projects, and therefore we don't have any operational control, or we don't take board seats. And therefore, we are a passive investor, unlike a joint venture, which would, very much be very involved in the ongoing operation of the project. So, commodity streaming, it's now been around for 8 years. Between the group of us who are doing commodity streaming, I'd say we've probably deployed somewhere around $5, $6, or $7 billion into the mining industry. It's a significant amount. You've got some of the biggest mining companies in the world who have done streams, from Barrick to the Glencores to the Goldcorp, to the Vale, who's done the biggest one to date. From a streaming perspective, we're looking for projects that have good exploration upside, production upside. We're looking for management teams that are capable of building projects, and we're looking for projects that are ready to get into that construction phase. I mean, timing is a big issue for us. We see a lot of very early stage projects that might be great projects, but it's just a bit too early for a commodity stream. The reason for that is when you're doing a stream, and as I said before, when you're doing this discounted cash flow analysis to figure out what the stream is actually worth, well, you have to be able to build an economic model on the mine to have a sense for what the production might be and what the mine life might be. So it's hard for us to get involved before there's a feasibility study or before there's a really good economic study done on the project. And we need to be very, very focused on finding those projects, and that's, at the end of the day, for a streaming company, you're relying on your ability to pick the good projects and pick good jurisdictions to invest in and teams to back. So hopefully that gives you a sense of what commodity streaming is about. I'm hoping that there's time for questions at the end, and happy to answer any questions, and I'll be here after as well. So I'll pass the mic over to John Anderson. John's a partner in the Corporate and Securities Group at Stikeman, and he's a member of the firm's National Partnership Board. He's also a member of the Global Mining Group at Stikeman's, and with a focus on mergers and acquisitions and strategic transactions. So welcome, John.
Thanks, Justin. There we go. So as I say, thanks, Justin. Great introduction. My job during the next 8 to 10 minutes is going to be to give you a flavor for the process of actually doing one of these deals and the sort of issues that will arise during that process. So Justin did a great job presenting a bunch of transactions, and fundamentally they all look pretty similar, that for a fixed upfront payment and a typically, I think you had one example where there was a zero payment, but typically there will be an ongoing per unit of delivery payment that covers the operating costs. You will be selling a portion of the commodity coming out of your mine. One recent transaction that I'll refer to a few times as an example is the Inmet sale of the gold, 80% of the gold and silver streams coming out of its Cobre Panama project, which is a copper project, to Franco-Nevada for $1 billion upfront and $400 an ounce for the delivered gold and $6 an ounce for the delivered silver. But, oops. So don't let this sort of standard way of describing these transactions fool you into thinking that they're sort of all the same. Key point number one, they're not. These transactions are all actually very, very different, every one. You heard from Justin that it all started 8 years ago, and it's really gained traction over the last few years. So the transactions aren't yet sort of cookie cutter like a bank project finance would be. There's still a lot of room to negotiate. The metal you can stream can be precious or industrial. It can be either your mine's main output, or it can be a byproduct, the silver out of your copper project. The upfront payment can be made at closing, like the recent Vale payment that they received from the 1.9 they received from Silver Wheaton, or it can come over time, like in the Inmet deal. That $1 billion came as construction was being advanced. the amount of the variable payment that you're getting on delivery of that ounce of gold or silver can either be capped at the then current market price or not. It can be adjusted for inflation or not. So there's all sorts of these basic variables that you can change around. Justin tells me the only one that's not really up for negotiation so much is the one that was in the recent Vale deal where it was capped at 20 years. He tells me they really don't want to do that and want to do life of mine. And I'll agree that it's very, very hard to find something that's not life of mine because they're obviously looking for the upside potential. So, but other than life of mine, pretty much everything's up for negotiation. In doing one of these deals, in effect, you're selling a piece of your project. And when you do that, from a legal perspective, that streaming transaction is going to look a lot like any other sale or borrowing transaction, and will go through the standard transaction phases. You'll have a letter of intent or MOU or something like that outlining the basic terms. The streamer will do their due diligence. You'll move to a definitive agreement, and then once you've got that done, you'll close your deal. And I'm going to talk about the few issues that I want you to think about up front in the phases of those deals. So during the letter of intent phase, in addition to customizing all of those basic features we've already talked about, there's two things you really need to give a lot of thought to. And one is, what is the project you're selling? What's the project AOI or stream area? And there's a lot of flexibility there. What you put up for bid is what the streamer will look at and give you a price against. The one thing you've got to remember, though, is to the extent you've got a number of targets in one geographic area, to include some and exclude others, it's got to be pretty clear, or you've got to have some clear method of delineating them, because the last thing someone wants to do is give a stream on half of a project and miraculously all the silver comes out of the other half of the project. The second thing you need to think about up front is security. Typically, a streamer will want security over the project, so that if for whatever reason the production is not going ahead and you're unable to complete it, then they'll be able to step in, presumably behind other secured lenders, to see that project get to fruition and production. But once again, there's a lot of flexibility, and in, for example, that Inmet deal I described earlier, that Cobre Panama project is 20% owned by a few Korean companies, and they didn't really want to have anything to do with the stream, and so they said, we're out, you can't encumber the project. And so Inmet told Franco, you can't have project interest, and so Franco took an interest in Inmet's ownership position in the project operator that owned the legal title to the project. So right up front, if you need to do something weird and wonderful, that's possible too. Just identify it early in the stage. Moving on then to the due diligence. The streamer's due diligence is going to cover the same ground that anybody else's would. They'll be investigating all the key issues like title, geology, metallurgy, engineering, permitting, and financing. They're going to send their own people together with outside consultants to scrub your project from top to bottom, develop their own block model, everything else, to test and assume, or test all of your assumptions and everything else, to make sure, as Justin put it, that they're betting on the best project that they can. So since they're taking on a bunch of risk and reward relating to both your mineral reserves and your resource estimates, metallurgical risks and operating risks, they'll really want to understand what those are, what the downsides are, and what the upsides are. So when you're putting your project due diligence package together for them to look at, think about that so that you can make sure you prepare the materials necessary to respond to those issues so that they can walk away with a good understanding of those risks and therefore give you a better price on your project. If you make it through the due diligence phase, you'll be moving on to the phase where you document the transaction. And the way you do that, it's actually pretty document light. Unlike a bank credit facility that'll have closing books this thick, a transaction like this is pretty straightforward. There'll be typically one definitive agreement called something like a metals purchase agreement, and then there'll be a few security documents that involve the security over the project, and that's about it. Things that come up during this phase: first, definition of the project. notwithstanding the fact you've already dealt with it up front. Once they've done some due diligence, a streamer will want to make sure that there really is appropriate delineation between what's in and what's out. If you've got one target in Mexico and another in Spain, this is not going to be an issue. But when you've got 3 targets all along one geological formation in Mexico and you're trying to exclude some of those and include others, that's going to be difficult. So if you're in that situation, this is probably going to come up again. And as an example, after Franco did the deal with Inmet, Inmet made a bid for Petaquilla right next door. And as you can imagine, Franco probably wouldn't be too happy if this turned into a super project and a whole bunch of the stuff coming out was coming from Petaquilla, and that reduced the emphasis that was placed on the Cobra Panama project, where Franco's actually going to get their return. So there's an example of how that issue will come up. Next thing, next big area is the covenant package. This is going to be pretty easy. As Justin said, interests are aligned. They want to be aligned. And so your covenant package is basically going to ask you to operate the project in a commercially reasonable manner, which is pretty easy. That's exactly what you're planning on doing, so nothing very offensive. The one issue that typically comes up with respect to the covenant package relates to commingling. The streamers typically don't want any commingling. They don't want a processing facility that they helped pay for to be processing ore from somewhere else on which they're not getting any return or any deliveries out of. So there will be commingling coming up if that's a potential in your project as an issue. Next one, security and intercreditor arrangements. So assuming you haven't done something very special up front, this is always going to be an issue in the detailed documentation phase. And while interests are aligned, and Justin will want to make sure you get the financing necessary to do your project, the last thing you want to do is to be planning on plan A, and then it doesn't come to fruition and you need to implement plan B, and you have to go on your knees to ask Justin to change things around slightly. So you really do need to think about what you might be doing and what you're planning to do, and make sure you ask for the flexibility up front when it's very easily given, to make sure you can achieve your end state. Lastly, tax and accounting. While Brad and Carrie will get into it in a lot more detail, I just wanted to mention 2 key points. The first is that what the documentation says will actually drive the tax and accounting. As Justin identified, gee, if this looks more like a royalty, it might be taxable up front. If it looks like a commodity sale, it's not going to be taxable up front. So lots of attention is paid to the document to make sure you achieve the tax objective you're looking for. And secondly, these are really long-term arrangements. Life of mine, 30 years, 40 years. Tax laws can change over time and situations can change. You might be wanting to re-domicile, and that could have a different tax impact on the structure. So typically these documents will provide that to the extent somebody wants to introduce a change, it's not going to be at somebody else's cost. You're going to have to re-domicile, you're going to have to say, I'll cover you for that risk. And secondly, to the extent there's unanticipated changes, they'll often have a covenant requiring everybody to renegotiate the deal so that you're put back where you all thought you would be, notwithstanding that tax change. They don't typically require you to be at a disadvantage, so as long as it's not disadvantaging you, you'll have to accommodate the streamer, and vice versa. So those are the big issues that come up in the documentation phase. As I said before, closing these deals is then quite straightforward. It typically involves satisfying the conditions, which means putting the security in place, which should be at this point pretty clerical, mechanical stuff that'll happen over the course of a few weeks or a month or so to get through the registries. And then once you've done that, you get to your closing, and the closing will either involve giving you your large upfront payment, like the Vale deal where the 1.9 was put in the bank, or staggered closings, like the Inmet deal, where the money comes as construction draws are required. And in those cases, you'll have to meet some additional minor closing conditions for each draw. So that's what the deal looks like, and those are the issues. So that completes my little part of the topic. So I'll now turn you over to Brad of Deloitte, who will be speaking about the tax treatment. Brad's a tax partner in the Vancouver office of Deloitte, specializing in corporate and international tax. He's the Vancouver office leader of their international tax service line, and he's also, and more importantly for you, Deloitte's Canadian mining tax co-leader.
Thank you, John, and good afternoon, everybody. So we obviously heard, and you all know, that the state of the capital markets is dreadful. However, the state of the alternative financing market is pretty rosy. Sandstorm and other streamers have lots of capital. I have no capital myself, unfortunately, but I will talk to you a little bit about the tax implications of these streaming transactions today. Given the audience, given who you are, I will be talking primarily about the tax perspective of the producers. And tax doesn't drive everything, although sometimes we like to think so. But there's a lot of dollars involved. You heard about a lot of the deals, very significant amounts, especially in that upfront payment. Very important that you get the tax implications correct. You don't want to have adverse or unexpected tax results. One thing I do want to say at the outset, because I've been asked the question a few times, is what's the tax angle? What's the tax play on this? And really, it isn't. As many of you know, this is really commercially driven. You heard of all the benefits from others who spoke already. It's financing to get mines up and running, etc. So first and foremost, these are commercial deals. And for the most part, just don't want tax to get in the way. You don't want to add tax where there wasn't some before. Don't want to pay tax too early. There are planning possibilities as well for certain. Depends on the participants, depends on the appetite for tax risk, depends on the jurisdiction that you're in, but there is planning available. As was mentioned before, and as you all know, there are a wide variety of situations. John mentioned a lot of the possible different legal aspects to the deals. Of course, there's different metals, different geographies involved, different stages of development. Having said all that, and as John said, in essence, this is a purchase and sale of a commodity. That's what the essence of the legal contract is. The changes from just a traditional sale of metal is that you got this big upfront payment and it's a long contract length. As John said, and this follows in most countries, including Canada, tax follows legal. So the legal reality of what you have, very important, as John mentioned, and so getting the contract language correct is critical. I'm going to talk broadly about two different scenarios. One is the Canadian setting, and one is the foreign. So in the Canadian situation, simple diagram, you've got a Canadian project, various stages of development, of course, depending on the situation, typically held by a Canadian corporation, and that's the party with which the streaming company is transacting. So money flowing one way, and metals or credits flowing the other way. So what do we think about in Canada? What do we worry about in Canada? Well, first of all, what do you have here? And it's a sale of a commodity. Mining operations in Canada, the CRA will tax you on your profits from your business. Mining operations are no different. The difference here again is that you get this large upfront payment. So one of the critical aspects in terms of planning or avoiding trouble in Canadian deals is to try to defer and amortize that upfront payment into income over time. And the good news is, especially if you, again, contract properly, have the good legal terms in it, you can often, almost always, defer and amortize that upfront payment over the life of the mine or over the term during which ounces, pounds, etc. are delivered. You'll quite often see in agreements, the way it's evolved, that the upfront payment is treated as a deposit and it's drawn down as ounces are delivered. It does help the producer somewhat in that defer and amortize argument. Perhaps not critical. It does help the streaming companies somewhat. Helps them on their inventory costing side if they're a Canadian counterparty. Categorizing as a deposit as well is often helpful in a mining tax situation with our provincial mining royalties. Okay, on the foreign side, this is a typical picture. It's not the Vale example, of course, but for many of you in the room, quite common to have a Canadian public company owning a foreign mining project. Typically, the foreign project is in a foreign corporation, a subsidiary of the parent. and the contract is between the streamer and that foreign company. It's not unusual to have other companies within the group being party to the contract for various guarantees, etc., but that's essentially the picture. And really the tax drivers are the same in what I described in the Canadian setting. Most foreign jurisdictions will again tax you on your profits made from a mine. So the difference here, you get an upfront payment. How will that foreign country treat the upfront payment is the important question. Now, of course, it's a big world. There are a lot of different tax regimes, a lot of different rules, ranging from the very sophisticated, like the U.S., for example. The U.S. is one of the countries where they actually follow substance rather than legal form as a general rule. So they might not treat it as a purchase and sale of a commodity. They might treat it as a loan because it looks like a loan. But again, the contract terms do matter and various other facts. You can go to the other end of the spectrum and have very unsophisticated tax regimes in the world. Some where their tax rules are basically on one piece of paper, and that creates other obstacles, like how are you going to treat this upfront payment? And certainly when a foreign government sees a lot of money coming in the door, you can understand that they might want to get at that early. So a lot of the work on the tax side is again trying to figure out how to deal with that upfront payment. And there's various techniques and things that have evolved over the years in terms of dealing with that. Just one note here, even though the counterparty on the producer side is the foreign company, Canada has international tax rules, and still those contractual terms are important from a Canadian point of view. We have rules, I'll call them look-through rules. Canada will tax certain types of income earned by the foreign company, even though they're earned down in the foreign company, typically passive types of income. So John had mentioned, you can have different contractual terms, and if you have it as defined as a sale of a royalty rather than a sale of a product, you start getting into some of our rules where you might be subject to tax in Canada on the receipts by the producer corp on these streaming deals. So again, a lot of care and attention is paid to those to make sure that you don't have adverse Canadian results in this situation. Justin mentioned streaming as compared to royalties and went through a number of items and actually briefly touched on this as well. I won't spend much time on this then, just to say, as Justin said, in the royalty, if a Canadian producing company, I'm just going to talk about Canada, every country's different, so can't describe them all here, but for Canada, you get money in as a company and you issue a royalty interest, you have to deal with that in year one. It comes into your taxable income calculation in some shape or form. It goes into one of your resource pools. If it goes negative, you have income. Then it's a numbers game. Do you have losses available to offset? Things like that. So it's, again, you deal with it year one. Streaming, again, if you can defer and amortize, you're dealing with it over many, many years, that upfront payment. So streaming does look better from an income tax point of view in Canada. And lastly, again, big world, there's not just income taxes to deal with, there are withholding taxes, duties, VAT, you name it. Again, these deals, you don't want to cause additional tax, and so a lot of effort is put in to achieve that. I'll just say, a long story short, they're manageable. You might have, again, interesting jurisdictions with interesting taxes. I haven't seen too many circumstances where you can't get around something. And again, this isn't playing fun with foreign tax rules. Again, just trying to keep the status quo, not trying to create adverse tax results. Briefly, streaming company perspectives. Any deal, in fact, any deal where you have a counterparty, that counterparty is going to have their own tax viewpoint, their own tax structure, their own tax considerations, and in any deal, you'll have to deal with that, and there's some to and fro. Streaming companies no different, royalty companies, etc. So don't be surprised if you're entering into a transaction with a streaming company that taxation will come up, and they might want to push a certain way or another way in order to get certainly a good result for them. But along the lines of alignment of interest that's been mentioned a few times, certainly streamers, I'd say, are not in the business of trying to get their counterparties in trouble on the tax side. So it's a lot of working together to make sure you've got, again, the good result. You will see streaming companies trying to avoid a taxable presence in jurisdictions in which they operate, because they operate around the world. And again, that's not a horrible thing, I'd say, from a tax policy perspective. Most countries in the philosophy of tax, you don't get taxed somewhere just by virtue of buying a good from a country. And really that's what streamers do. They're buying commodities from various countries. So trying to stay out of their tax net is certainly a reasonable thing. Changes in tax laws, John mentioned that. The contracts are set up to try to deal with that if they occur. And that's it on tax. I'm going to pass it off to my partner, Carrie Daniluk. Carrie's from our national office, and she does a lot of advisory work on IFRS, financial instruments, and doing a lot of mining work with us here in Vancouver. Thank you.
Okay, thanks, Brad. Good afternoon, everyone. So one of the most important messages I want to leave you with on the accounting front at the end of the presentation, I guess we're just getting down to what are the key messages, is don't forget about accounting. So we've got we've decided how the deal's going to be structured and so on and so forth. But before final signing, it's a great idea to get accounting advisors and auditors involved, because people do have different views on how these things should be accounted for and what could happen on the accounting front. So we kind of view the accounting as a bit of a spectrum. At one end, there's it would look more like a financial liability or a debt outstanding. At the other end, deferred revenue. So the first thing that's going to happen is you're going to get that big upfront payment in. And so that creates a liability, something for the right-hand side of the balance sheet. What is it? Is it debt or is it deferred revenue? Now, obviously, if it's debt, then there's going to be debt on your balance sheet, could affect covenants, borrowing limits, so on and so forth. There could also be volatility in the P&L, in the income statement. On the other end of the spectrum, which is usually what people try to get to, is the deferred revenue treatment, which we've talked about how the legal nature of these arrangements is that they are sales of commodity. That accounting would be more reflective of the view that it is actually a sale of a commodity. But accounting will try and look to the substance of the arrangement, and accountants will look at all the terms and say, on balance, is it more like a debt holder's interest, or is it almost more like an equity type interest? We talk about it as looking at the extent of mining risk that the streamer has taken on. If the project's not producing, are they getting anything? And so there can be terms in there. If we look at somebody who got to the financial liability treatment on their financial statements, that would imply that the mining risk is thought to rest more with the producer. So the streamer hasn't taken on as much. Tends to be shorter contracts. There would be more minimum cash payments, that kind of thing. More assurance that the streamer, or the investor, I guess I'll call it, would get paid out in cash. So that would start to look more like a financial liability or a piece of debt. Now, different people have different views. We don't have on-point accounting standards. Standard setters are sort of starting to look at these contracts because they're reasonably new. And so we don't. So it's very judgmental. Different accountants can have different views, which is why I say it's so important to get your auditors and advisors involved, just so you don't end up with unexpected results at the end. So if you had a financial liability, what would you have? You'd have, well, first of all, it's not on the slide, probably should be, you'd have something that looks like a debt on the balance sheet. You'd have interest expense. You'd have P&L volatility. Sort of from a technical accounting reason, the thinking would be that there's almost a derivative in there whose value varies with the value of the commodity. So profit and loss volatility, which doesn't usually make people happy. Lower revenue, because as you produce and provide ounces into the contract, it would be like you're paying down the liability and not having revenue. So at the other end of the spectrum, and this is more where we can see both treatments. If you looked at a sample, you would see both. And you might even think that the situations look similar because different judgments are being made. And because the contracts are not always exactly the same. So at this end of the spectrum, we'd be saying, well, the investor is taking on some more mining risk. If the project is not producing, he's more at risk of not realizing anything. Maybe it goes all the way out to that being paid back, that upfront deposit at the end of the term of the contract. So fewer hooks into being able to get cash payments. We need to look at all the terms together. There's kind of no one thing that would tip you one way or the other. So if we have deferred revenue, we would have, as the ounces get produced, revenue, because, and Brad mentioned it, you'd be amortizing that deferred liability from the balance sheet over to the income statement in the revenue line. No finance or interest charges, and possibly likely no embedded derivative, less volatility in the P&L. So I think you can see why, and no debt on your balance sheet. It's a deferred revenue credit. So you can see, I think, why it's turning out to be the preferred treatment. But as I said, just some more cautionary words. Different people have different views. You can see diversity in practice for sure. So that's why it's a good idea to get a handle on it going in. And just stay tuned, because the standard setters are looking at how these things are being treated. So I think with that, we are right at 3 o'clock, but I'm going to open it up for questions. Could we provide some contrasting differences in terms of costs and difficulty between this streaming and more traditional kinds of financing?
Yeah, sure. Good question. The simple answer is the streaming companies will pay for all of their own costs. So there's no lawyer fees or due diligence fees or upfront fees. We don't take warrants. At the end of the day, we're picking projects that we want to invest in, and we treat ourselves like equity investors and pay all of our own costs.
On your side, on the legals, I'd say it's probably half of the cost of a full-blown project finance. That's on the legal side. On the accounting tax,
Tax, I'd say it probably depends on the jurisdiction, what you're trying to achieve, but debt financing is typically quite easy to deal with, or traditional. So I think the effort involved on tax would be more on streaming.
And I guess just from the accountant standpoint, if you're not doing a prospectus, then that's always less costly. It's basically, how would a producer choose among the available streaming companies, essentially?
Yeah, great question. I think the big difference between, if you're looking at a Franco-Nevada or Royal Gold or Silver Wheaton, it's more the space that we play in. So you'll see that in the Vale deal, for example, that was a competitive process between the three larger streaming companies. We were not involved. They're chasing, for the most part, the $300, $500 billion deals. Sandstorm is playing more in the sort of $50 to $200 million space, and then there's a lot of companies that are also chasing on the smaller space, sort of sub $30 million, sub $50 million tickets. So you find that we each operate in slightly different areas. So you may find that, Sandstorm, for example, if there's a $100 million offer, a $100 million stream that's presented to all of the streaming companies, you might find us being a bit more competitive in terms of the terms that would be in that agreement, because that's our space, and that's where we're going to create the most value for our shareholders. At the end of the day, it probably comes down to more the valuation that the streaming companies are willing to provide as part of the offer, and the flexibility that's incorporated into the agreement. So as you've heard here today, there is quite a bit of flexibility in the way these things are structured. They're not cookie cutter by any stretch of the imagination. So it's more about the flexibility that the different streaming companies will offer, that might lead you down one path or the other. But the mandates are all very similar. We're all looking to do streaming or royalty transactions, for the most part, more streaming than royalty, and we're all looking to create value for our shareholders. So it's very similar in that sense.
I think there was a question here, yes. So the question is related to screening criteria, what kind of screening criteria there are. Could a pre-feasibility company qualify? And I guess the comments also made is there's a variety in the quality of feasibility studies.
Yeah, good question. So on the pre-feasibility study, yes, a pre-feasibility study has been enough. We've actually done a stream on a project that didn't have a pre-feasibility study, but there was enough information to build an economic study on that mine. The second question on do we critically assess the feasibility studies? Yes, I mean, very much so. As you indicated, all feasibility studies are different, done at different commodity prices, using different mining costs, maybe using different mine life. So when we do our due diligence, and this would probably take us a week to 2 weeks, but we would hire a resource geologist, we would hire an engineering consultant, we'd hire a metallurgist. I mean, we would hire a group of, we call it 3 to 5 people who would help us critically assess that project, and they're guys who have been in the industry for 50 years and can tell us their mining costs are too low, or their timing is way off, or we can look at it and say, you know, using $1,700 gold is probably not the right price to use. But so we will go in and kind of break up that feasibility study into its critical components and make sure that we're comfortable with all the key aspects of those feasibility studies, and then make our own decision on whether to invest. The feasibility studies are very good benchmark to sort of get us a sort of high level understanding of the project, and then when we go and do the detailed due diligence, that's when we dive into the into the specifics.
So the question is around the streamer taking security over the project and creating problems with flexibility for future financing and debt.
Yeah, I guess the simple answer is, you know, they're all different, and the security arrangements under each stream are different. We are very focused, as I think a couple of people have noted, that we don't want to partially fund a project, so we need to be focused on the partner that we're dealing with and their ability to raise debt or equity or other sources of alternative capital. So, you know, we do spend a lot of time thinking about security and how the security that we take would be impacted when the company is looking to do a project financing or a partner financing in overseas, for example. So we do spend a lot of time on that area. Generally speaking, we would just say in any material aspects, Sandstorm or commodity streaming companies in general would subordinate to cash flows and certain aspects that a project lender would really focus on. So you know, they're all different, but we do spend a lot of time thinking about those things.
So what percentage of the CapEx normally gets financed?
I would say as a ballpark, somewhere between 25 and 50%, but it varies by a fairly significant degree. I mean, we have financed projects where it's 100% of the capital, and we've also financed projects where it might be 10% of the, 5 to 10% of the capital requirements. So it varies. But generally speaking, as I said, we're sort of limiting the streams to 15 to 20% of the production from the mine, or the net asset value of that mine. So, I like to use a ballpark. If we're providing 20% or we're taking 20% of the production, you're probably providing somewhere in the neighborhood of 50% of the capital. So that's kind of the promote, is taking 20% of the production, providing 50% of the capital, leaving the other 80% of production for all other sources of financing.
So the question is, where do the streaming companies get their financing?
Yeah, I think the end of your point there, we're public companies. We get all of our money from the public equity markets. Haven't done any private equity. It's all public.
Another. Sure. So the question relates to ongoing payments and how historically they've been designed to cover the capital expenditures. I guess the question is, how is that basically evolving over time, essentially? Yeah.
Yeah, good question. You're right in that when we set up some of our first contracts, and they were, $3.90 an ounce on silver during the Silver Wheaton days, or $400 an ounce for gold. In those times, that's what it costs to pull an ounce of gold out of the ground. We would still look for projects where that would be true, frankly speaking. We're not chasing the projects that have $1,200 or $1,100 or $1,200 or $1,300 all-in costs. We're looking for the lowest, lowest or within the lowest or second lowest quartile in terms of costs. So I think you could see ongoing payments pushed up to $600 to $650 an ounce. At the end of the day, we're making our money on the spread between the realized price of gold and the ongoing payment that we're paying. So, and we're looking to generate cash flow, and that's what we build into the discount cash flow analysis when we do the stream on day one. So, it is just a math game. So to the extent you could push up the ongoing payment to $1,000, but then there would be very little spread left over at the end of the day to do your upfront payment on, and therefore your upfront payment would be very small. So it's again one of the reasons why we want to limit the size of the stream, because at the end of the day, we realize if we're paying $600 or $700 or $500 an ounce as an ongoing payment, we're probably not covering every dollar that goes into producing that ounce on an all-in basis. But it just does get reflected in the discounted cash flow analysis. But you won't see a streaming company push it up to $1,000 an ounce anytime soon, just because you need that spread.
Question is, would a streamer get in earlier than the feasibility stage? Maybe
Yeah.
with a more aggressive discounting? Yeah.
Yeah, the simple answer is yes. For us, it's more about what the project looks like, what we believe the project is going to look like in, when it's producing. What do we think about the management team? What do we think about the exploration upside? At the end of the day, when a streaming company provides this large upfront payment on day one, we're taking a lot of risk on day one because the project, whether it faces permitting risk or jurisdictional risk or capital risk or operating risk, whatever it may be, we're looking, because we're taking that large amount of risk up front, we're looking for projects that give us that reasonable upside or return on the back end. And for us, that's exploration upside or production upside. So anything is possible for a good project, I would say, because of the flexibility we have in the commodity.
So the question is, if the mine's not gonna be ready for another 2 years, say, or be built for another 2 years, when would we do the DCF back to? Yeah. Yeah.
Yeah. The simple answer is when we write the check, but it would, or when we're doing the analysis or the financial analysis. So it would, when I build the model, it says, on what day do I think I'm going to sign the definitive agreement? And that would be the day I'd use for my discounting.
Question is, do they ever take equity positions?
We have, but I would say in very unique circumstances, it's not a key part of our business model, taking equity.
Do they ever turn down a project because it's too small?
Yes. We're now in Sandstorm, we're a sort of $800 million company. There are projects that for us just don't move the needle for our shareholders, frankly speaking, and would take up too much time to kind of justify the potential accretion to our shareholders. So generally speaking, at Sandstorm, we're looking in that sort of $30 million to $200 million range, and would not look at opportunities smaller than $30 million for the most part. And we do have, from Sandstorm's perspective, we have an investment in a company called Premier Royalties, who for us would do some of the smaller transactions less than $30 million.
Other question?
Yeah. Okay.
Okay, so thank you for coming and staying till the bitter end here. And I think we'll be up here at the front if people would like to come up and ask questions separately for a bit. Thank you.